Before you buy your first stock, you need to answer one question. Are you an investor or a trader? Because these are two completely different games with different rules, different time frames, and different checklists. A trader cares about what the price will do in the next hour, day, or week. They use charts, patterns, and indicators. That's technical analysis. An investor cares about what the company will be worth in 5, 10, or 20 years. They read financial statements, study the business, and buy a piece of a real company. That's fundamental analysis. This video is for the investor. If you want to know how to read candlestick patterns or find the perfect entry point, that's a different video. But if you want to learn how to vet a company before you invest your hard-earned money, stay with me. I'm going to give you a 5-minute fundamental checklist that will change how you look at stocks forever. Every stock picker uses one of two checklists, sometimes both. The technical checklist asks, what is the price doing? Is it trending up? Is there support here? Is the RSI oversold? Are buyers stepping in? It's fast, it's visual, and it's all about timing. The fundamental checklist asks a completely different set of questions. Is this company actually making money? Does it have more cash than debt? Is the stock price reasonable compared to what the company earns? Do I even understand what this business does? Technical analysis tells you when to buy. Fundamental analysis tells you what to buy. In this video, we're going deep on the fundamental checklist, because if you buy great companies at fair prices, the timing eventually takes care of itself. Check number 1. Is this company actually profitable? This sounds obvious, but you'd be shocked how many people buy stocks in companies that have never made a dollar. Open the company's income statement. Look for one number, net income. If it's positive, green light. The company made more money than it spent. If it's negative, red flag. The company is burning cash. But don't stop there. Look at the trend. Is net income growing year over year, flat, or shrinking? A company that made 100 million last year and 120 million this year is doing something right. A company that made 100 million and then lost 50 million. That's a story you need to understand before you invest a single dollar. Also, check the profit margin. That's net income divided by revenue. A grocery store might run on a 2% margin. That's normal for that industry. A software company should be running 15, 20, maybe 30%. If it's at 2%, something is broken. The point is, profitability is not just a yes or no question. It's a trend, it's a margin, and it's your first filter. Check number 2. Does the company have more cash than debt? This is where a lot of beginner investors get caught. They see a company with huge revenue and assume it's healthy. But revenue is not cash. And cash is what keeps the lights on when times get tough. Pull up the balance sheet. Find two numbers, total cash and cash equivalents, and total debt. If cash is bigger than debt, the company can weather a storm. It can invest in growth without borrowing. It can survive a recession. If debt is 3, 4, or 10 times bigger than cash, you need to ask why. Is it a capital-intensive business like an airline or a utility? Some debt is normal there, but even then, compare it to competitors. Is it a tech company drowning in debt while burning cash? That's a recipe for a dilutive stock offering. Or worse, bankruptcy. Warren Buffett calls this the margin of safety. I just call it common sense. Don't invest in companies that are one bad quarter away from a crisis. Check number 3. Is the price actually reasonable? You can find a wonderful company and still lose money if you pay too much for it. The simplest tool for this is the price-to-earnings ratio. the PE ratio. Here's how it works. Take the stock price, divide it by the company's earnings per share. If a stock is $100 and the company earns $5 per share, the PE is 20. That means investors are paying $20 for every $1 of annual earnings. Now, is 20 high or low? It depends on the industry. A mature bank might trade at a PE of 8 to 12. A fast-growing software company might trade at 25 to 40. A speculative biotech might trade at 80, or have no PE at all because it has no earnings. So here's what you do. Find the company's PE, then find the average PE for its sector. If it's way above the average, ask yourself, is this company really growing that much faster than everyone else? If the answer is no, you might be overpaying. Another quick trick, the PEG ratio. That's the PE divided by the expected earnings growth rate. A PEG under 1 is often considered attractive. Over 2, you're probably paying a premium. Price matters. Never forget that. Check number 4. Are the people running the company putting their own money where their mouth is? This is one of my favorite checks because it's so simple and so revealing. Company insiders, the CEO, the CFO, the board members, know more about the business than any analyst on Wall Street. They know the order pipeline. They know if a new product is flopping. They know if the next quarter is going to surprise everyone. And every time they buy or sell their own company's stock, they have to file a public disclosure. So look it up. If the CEO is buying shares with their own cash, not stock options, not grants, but actual open market purchases, that's a powerful signal. They believe the stock is undervalued. If multiple insiders are selling, that doesn't always mean disaster. They might be diversifying or buying a house. But if the CFO, the COO, and 3 board members are all dumping stock at the same time, that's a red flag you cannot ignore. Insider buying is a green light. Heavy insider selling is a yellow light. Heavy insider selling combined with missed earnings guidance, that's a red light. Check number 5. And this might be the most important one. Do you actually understand what this company does? Warren Buffett calls this your circle of competence. I call it the "can I explain it to a friend over dinner" test. If you cannot explain in 2 sentences how this company makes money, who its customers are, and why those customers keep coming back, you should not invest in it. It doesn't matter how hot the stock is. It doesn't matter that your brother-in-law made 300% on it. If you don't understand the business, you cannot evaluate the risks. Can you explain how a bank makes money? Yes. They take deposits, pay low interest, lend at higher interest, and keep the spread. Can you explain how a semiconductor company makes money? Maybe. They design chips, manufacture them, and sell them to electronics companies. Can you explain how a biotech company with no revenue, 5 clinical trials, and a patent portfolio values itself? If the answer is no, that's okay. Just don't invest in it. Some of the best investors in the world have built fortunes by only buying businesses they understand. Coca-Cola, Apple, Walmart, simple, understandable, profitable. That's the bar. So there it is. The 5-minute fundamental checklist. 1. Is the company profitable? And is profit growing? 2. Does it have more cash than debt? 3. Is the stock price reasonable compared to earnings? 4. Are insiders buying, or are they running for the exits? 5. Do I understand what this business actually does? If a stock passes all 5 checks, it deserves a closer look. If it fails 2 or more, move on. There are thousands of stocks in the market. You only need 10 great ones to build wealth. Remember, This is the fundamental checklist. It tells you what to buy. If you want to know when to buy, that's where technical analysis comes in. And I'll cover that in another video. If this checklist helped you think differently about stock picking, subscribe to MU Wealth. I break down investing, trading, and wealth building in simple, no-fluff videos. Drop a comment with the stock you're analyzing right now, and which of these 5 checks it passed or failed. Thanks for watching MU Wealth. If you enjoyed this investment video, subscribe for more practical investing content. Remember, the market doesn't need to change. Our decisions do.